Okay. Now, how do you actually estimate these variables? So the risk-free rate is just a traded government bond. You can get that very easily from Reuters or Bloomberg. The beta is actually easy to estimate. You just take your historical returns of the company. Okay. Returns is just the difference between the share price yesterday and the difference between the share price today, whether positive or negative. And you take a long enough history. So you look back. There is a lot of argument as to whether you should use historical data, because given us being part of the crisis generation, the past 5 years, with everything that's happening with the World Economic Forum's Great Reset, you don't really know if the world will be the same going forward. So whether you can use historical data is anybody's guess at this point in time. But it's relatively easy if you want to do it by the book and how most people and most practitioners do it in the market. You just take a relevant enough history and you calculate the covariance of, or just covariance is like the nature and the size of the variability between your individual share and the market. Okay, divide that by your variance and it gives you a correlation coefficient, which is your beta. Okay, so this is actually easy to estimate using historical data. The trick is, how do you, and this is historical market return, okay, for this beta calculation. The trick is here, how do you calculate this market return in the formula here? You can do it backward looking. You can use the same data set you used for your beta, or the historical price movements of an index. So in South Africa, we have the JSE Top 40, which is used as a proxy for the entire economy. It's the top 40 companies on our stock exchange. You can use the S&P 500, you can use the NASDAQ 100, just an index that pretty much summarizes the entire economy. You can use historical data for that to estimate what your market return. You can find an average of what it was historically. The problem is, how far back do you go? Do you go back 100 years to smooth out any of those irregularities? Do you go back 1 year? Because now we've been living under this brave new world for, call it a year now. So maybe 1 year is a good estimate. But having said that, there's a lot of volatility in 1 year. So what period do you take? That's an open question. You can also do a forward-looking calculation of your market return. And this is done, I saw a professor at NYU do this, and I thought it was quite intelligent. What he does is he takes the value of the index. So let's say we've got the value of the NASDAQ over here. Let's assume that we're doing the valuation. We go back in time and we're in 2008 and we want to calculate what the expected market return will be in the future. You take the value of the NASDAQ at today's date, which is 2008. And then you'll have a bunch of analysts that will say, we predict that the NASDAQ will rise 2% year on year, okay, for the next 5 years. And thereafter, it's anybody's guess. But then you have the World Bank and you have other sources of information that predict that your country's economy will grow at 1%, if it's the US, 1% per annum thereafter. So what you can then do is you can inflate the NASDAQ at 2% year on year for the next 5 years, according to industry consensus. And then after year 5, you can inflate it at whatever your economy of the country that you live in will be growing at. You then take all the dividends or assumed dividend yield or dividend payouts of the next 5 years on this index, and you simply value it the way you'd value a bond. You take the dividend payments of every single year, and you take a terminal value, okay? Those of you who've done M&A work, you take a terminal value, and the terminal value, you can just use the growth rate of what the World Economic or World Bank estimates your economy will grow at in the 10 to 20, 30-year future. You can use that to find your terminal value. And then you would discount it at a rate that makes the value of the index today equal to the value of all the dividends that you'll earn and the present value of your terminal value. So that's a forward-looking market risk, rate of return. I just see some questions. Let me just finish the point and then I'll answer the questions. Okay. So yeah, the forward-looking method involves a DCF method, almost like valuing a bond. Equate the price of the index today to the present value of consensus forward-looking dividends and consensus forward growth rate of the index. The rate that satisfies this equation is the market rate of return. Okay, so just doing that, that's how you'd calculate cost of capital in the mining industry. I just want to take the question even further. In the mining industry, you have certain stages. Okay, before I go on, I saw some questions in the chat. Let me just see. How do you achieve your optimal capital holding, i.e. the proportion between equity and debt? Holding too much of either instrument has devastating effects on profitability. Oh, very good question. Okay, wow. Optimal, define optimal. If you are a mining startup, it's optimal that you have zero debt, my friend. So define what optimal is. You can do some mathematics to solve for your maximized return on equity. If you look at the formula here, let's just go back to this one. If you look at the formula here, you have the market value of equity, right? Just stay with me here. We're going to just bounce a lot of variables up in the air. If you have a lot of shares in issue, so you have a company that's funded entirely by means of equity, okay? Potential investors on the stock exchange see this company as very lowly geared. In other words, your management team lacks dynamism. So that's going to depress your share price, okay? A depressed share price, stay with me here, a low share price increases your cost of equity, okay? You want to entice people to buy your shares, so you have to incentivize them to buy your shares. You have to make up for it somehow, okay? So you have to promise them higher dividends, okay? So if you have a firm that's weighted entirely through equity, your shareholders will only be happy with you if you are generating a lot of dividends in your company. You're making them happy, okay? If you're a low dividend paying share, but you've got a lot of leverage in your firm or your shareholders see that as you are borrowing money in the market at a lower rate than the cost of equity. The higher you gear a company, the higher the return, everything remaining constant, the higher the rate of return for your equity holders, because the more you gear a company, the more the leverage of that company. So yeah, I mean, to put all of those variables together, it depends on what is optimal for you. If it's optimal for you to have a robust company, it's in a mature environment, then you might want to retire some debt, especially if your mine is nearing the end of its life. It would be optimal for you to have less debt on your balance sheet and more equity. If you're in the mining space, you can't gear as much as companies in the retail space because of the cyclicality. So optimal, from me, I was in the debt space. Optimal to me is very different to optimal for somebody who's in the private equity space that wants to maximize their returns. For me, optimal is it a robust capital structure that will survive seasonality? And there, the optimal debt equity mix, the industry precedents like a 60-40 debt to equity. And there's also whatever your financial covenants are on your debt. Basically, I would take my cue from the financial model. If your company, how we calculate debt capacities, we look at the model. And if the company shows that there's too much leverage or too much debt, then it's not optimal, even if you are returning record rates of return to your shareholders. At the end of the day, a bank is not going to be happy to lend you money.